Hang Seng is up on your screen. That one is down around 150 points.
Like the next 20% will be much more painful than the first. Rates going up another 100 basis points are a lot more painful than the first 100 because people aren't used to it.
TCS Q2 surpassing expectations in both revenues, margins, constant currency revenue growth at 4%.
This has been a good quarter. And we have always been focused on staying very close to our customers and staying very close to the opportunity spectrum.
That's the Nifty opening, absolutely flat.
It's a good market for the long-term investors. You need some consolidation.
Yesterday, post-market hours, JSW Cement, they announced that they are acquiring Springway Mining Private Limited from around 477 crore rupees.
Exports for this particular quarter are up almost 20% on a sequential basis.
When it comes to the office space, the leasing exercise, well, DLF is seeing a rise in return to work, more inquiries, faster leasing.
It's holding 17,100, but in the last 1 hour, we've seen the selling pressure accelerate.
All right, 150 points lower is what we have on the Nifty. 17,087 is where we're at. I'm Prashant Nair. Alon, welcome to a fresh new edition of Closing Bell. With me in the studios is Reema Tendulkar, and joining us from the newsroom floor is Sonia Shenoy. Guys, hi.
Hi.
Good afternoon.
Hi, afternoon.
I mean, there is a bit of selling pressure. Can't be wished away. It's not very large in the context of the last 2 days that we've had in the US markets, but it is there. I mean, just under 1% cut on the Nifty. The big kind of two areas of the market which held out were the banks and the IT. IT is seeing a bit of profit booking. So that index was up 3% last week and it was up yesterday. So today we are giving back some, about 1.25% or so. And you got the banks, which of course have done very well, which is pulling back a little bit as well, 0.4% lower in terms of Nifty Bank. Market breadth today is also flipped. I mean, 2:1 almost in favor of declines is what is on your screens at this point in time. 2,000 stocks lower and about 860 stocks which are higher at this point. So lots to talk about, and I think one recurring theme which we will talk is the IT services space, Reema, and what the TCS number means for the rest of the IT pack, although we don't have to wait very long because tomorrow we have one number, the day after we have another.
Tomorrow too, and day after we've got one. You got that mixed up. But even now, though we're sharply lower and we've reached the 17,100 mark on the downside, there's still no panic in the market. We've been drifting lower and lower over the last 3 trading sessions. So today we're down for the 3rd day in a row. The high last week on the Nifty was 17,428. So compared to that level, we've lost close to about 350 points. It's also a very heavy week in terms of global economic data points. So on Wednesday, that's tomorrow, you will get the Fed minutes. On Thursday, as we've been saying, it will be the US CPI. And both these two indicators will shape the expectations of what the Fed is likely to do in the 2nd November meeting. So that's going to be very crucial. Will we get another 75 basis points rate hike, or will it temper down perhaps to a 50 basis point rate hike? So very important, the two indicators, tomorrow's FOMC minutes meet, and then on Thursday, the US CPI. Also on Friday, you've got 4 US banks coming out with numbers. JP Morgan, Wells Fargo, Citigroup, Morgan Stanley. So US also kickstarts its earnings season with 4 of the large banks. For our own markets, it's IT. We're down close to about 0.8, 0.9% on the Nifty IT index, but bear in mind, it's still up close to about 3% for the month. So there is that profit booking. The stocks had run up from very oversold levels in anticipation of numbers that perhaps the numbers could have a little bit of a beat. While the TCS numbers were good, there is nothing from the TCS management commentary which gives you a sense of what FY24 is going to be. So people who were on the fence still remain on the fence, right? There was nothing in the numbers to convince the bears, because the bears' whole argument was that next year is going to be bad. Yep. And there is no visibility that you've got from the management, so which perhaps explains why you are seeing that bit of a profit booking today, Sonia.
Absolutely, and I think it's all about global, right, Reema and Prashant? We've been talking about this ad nauseum as to how the global storm has sort of taken all boats with it, and India is not spared. Of course, that outperformance is there, but a couple of points, I think that's on the market's mind. As you rightly pointed out, there's a lot of data coming through, but the growth concerns have increased as well. I do know that what's happening in the UK is very UK specific, but still it's the big headline today. Bank of England intervening in the bond market, expanding that emergency program More importantly, Bank of England warning of a material risk to the UK financial stability. That doesn't bode too well for that entire region. Not just that, the Asian markets have had steep cuts ever since the start of trade. In fact, I was checking the Japanese market. By the end of trade was down in excess of 700 points. So it was a savage cut that we saw across the board over there. In China, once again, there are these anti-COVID measures that have been stepped up in a lot of key manufacturing regions, whether it's Shanghai, Shenzhen, etc. And now that again brings up the question of a slowdown in growth, right, for that entire pocket. For now, our own markets, of course, the Nifty has been holding on to the 200-day moving average of 16,980. So, Rima, let's see how it goes from here. It doesn't look like a great afternoon of trade if you're a bull, but still there's one more hour to go.
Okay, so let's tell our viewers what we've lined up for you in the last 1 hour on closing bell today. It's a red across the screen today with key indices at the day's low. The Nifty hovering below that 17,100 mark. The second day of underperformance for the mid-caps. All sectoral indices drag, but realty, consumer durables, metals deep in the red. Market expert Mehraboon Irani will join us to discuss fundamentals of the market. Not just that, we'll also take stock of technicals of the market with Jay Bala of cashthechaos.com. A couple of stocks on our radar today. India Cements and Divi's Laboratory. We'll track the news flow and tell you why they're a buzz today. And finally, Abhiram Elaswarupu of BNP Paribas will join in to help decode the market moves and the way forward.
All right, how should you position yourself in this last hour of trade? That's the question, isn't it? Mitesh Thakur of earningswave.com is with us. Mitesh, good to have you with us here. Thanks very much. Finally, we've got a dip which is not coming back very quickly. What should one do?
Prashant, my understanding is that, this is another failure to get past these levels of 17,300 odd, 17,300 odd zone. And this kind of condemns us back to the trading range of about 16,980, which is the 200 average area, to about 17,300. And in case we break below and we actually start trading with the 200 average, then I think we could retest the recent lows in the gap area of around 16,700, 750 zone to about 16,800. So it is a market which is definitely not showing any strong positive signal on the upside, barring IT, which despite the fact that it's come off, still has a indicator structure which is slightly on the positive side. And therefore, I think you will see a choppiness come in and a strong supply emerge at higher levels. So in that sense, I think trade with some negative bias. We are looking at now more of shorting opportunities, except the IT pack, and I have two sell calls right now. Havells is something which is breaking down very strong in a negative candlestick pattern over here, good volumes as well. So that's a sell. Keep a stop just above levels of 1301. Look for targets of around 1245 to begin with. And the other one is Eicher Motors. This is a stock which has done extremely well, but now showing first signs of correction. So that's a sell as well. Keep a stop around levels of 3470 and look for targets of around 3350.
Mitesh, at the index level, how low can we go?
On the index, as I said, I think, Rima, we could possibly look at a test of 16,980, 985 area, which is a 200 average. And in case you break that, then I think 16,800 to about 750 zone could be visited.
Okay, we're about 100 points away from our 200-day moving average, and there is a likelihood that that could be touched or breached. Market expert Mehraboon Irani is also with us on the show. Mehraboon, we've been talking about IT ad nauseum. Let's get in your views as well. What did you make of the numbers, the sell-off that we've seen post TCS's numbers and management commentary, and what would you attribute it to?
At the cost of repeating myself, I think consistently over the last 9 months, I wish to state that I have been very negative on the valuations which Indian IT companies were commanding. No complaints with the companies, their managements, the excellent companies, but the stocks were virtually owned by everybody on the street. You ask anybody and they were holding at least 2, 3, 4 IT stocks in their portfolios. So they had become completely overowned. Now, coming to TCS, I think absolutely no complaints with the numbers. The problem somewhere where the market is recognizing is the fact that Europe could be a problem. There could be concern over longer term deals. There are risks to the deal pipeline. There could be delays which could happen. That is the problem. Underlying story as far as IT goes is weak. The great companies, but the going is tough. Markets are supreme. The valuations have come down sharply. I remember possibly when TCS announced a buyback somewhere at 4,300, people said, oh, this could become a base for the stock, 3,800, 3,700. Look at where TCS is today. Now, at the present level, if you allow me to state my personal views, they are all ripe for a bounce. So 3,000, 3,100 of TCS, can it become a 3,400? Certainly yes. Or an Infosys going up 100 rupees over the next 1.5 months? Certainly yes. So a bounce is certainly on the cards. As I mentioned earlier, great companies. But if somebody will ask me, should I take a view and buy into IT now that they have come down very sharply from an investment angle, longer term angle, I would say I personally believe they have not bottomed out. In fact, I had gone on record to state in one of your shows early in the year, early in 2022, that to identify as to where the markets will bottom out, you need to see an Infosys maybe somewhere closer to 1,300 or a TCS somewhere closer to 2,700. And people said, what's wrong with him? What is he saying? I think we are now coming close to that. And before that can happen, or that may happen, and I hope I'm wrong on that, there certainly looks a distinct possibility of a bounce. Now, if you see the NASDAQ and the S&P, the way we are falling, I think if you have a bounce over there, which I personally again believe is very much on the cards, for what reason I really don't know, you could have this IT stocks giving you a quick 5, 10, 15% on the upside also as a from a trading angle. But buying from the longer term angle, fundamentally saying the great companies, yes, they are great companies, have they bottomed out? I don't think so, but they certainly look ripe for a 5, 10, 15% upside. A bounce in the market, a bounce in NASDAQ or S&P over there, and you may have people possibly looking at TCS and the Infosys and the Wipros of the world, and even some of the good mid-cap IT companies. So as companies, they are great. They look good from a trading angle right now for a bounce. But from an investment angle, I would still stay a little away because I feel they may not have it bottomed out from a longer term angle.
Okay, well, that's on the IT space. Perhaps there could be a pullback. You never know. Valuations also look attractive. So there's some headroom over there, especially for names like TCS. Mehraboon, good afternoon. I wanted your thoughts on a stock like Automotive Axles after the Cummins open offer announcement came through. This company, as we know, has had a very good track record. I mean, it's a 40-year-old company in this business. And now with Cummins coming on board, things, of course, there is a strong pedigree as well. As a long-term investor, despite the run-up that we've seen in Automotive Axles, does it still make sense to buy?
Clear disclosure in place that I'm personally holding the stock for the last over 15 years, and you are dead right. I think a lot of potential, a lot of decent products, good company, but somewhere as far as stock performance goes, there have been few periods where it suddenly made you feel very happy that you are a shareholder, but there were, I think, quite a few years where the stock didn't do anything. I think whatever has happened right now is certainly distinctly positive. It's going to have a big brand behind it, and possibly that now that the very fact that they have bought into it, I think the open offer which will be there will be mandatory, will be there for the sake of making an open offer. It could be at a price much lower, but at the end of it, or at the present price, will I buy into the stock? I may not be in a hurry to buy it, but to hold on to the stock, answer would be certainly yes. I think, again, I'm saying it's a great company, old company, and now with Cummins taking over, there are reasons to be positive as far as the longer term goes.
Okay, reasons to be positive. Any thoughts, Mehraboon, on IndusInd Bank? There was a block deal earlier today, and Route 1, which is a very large shareholder, I mean, they used to own 10% in the bank. I mean, the limit which any institution can own, that's now, I think they're down to under 5% or so. They sold about 1.5% or so. But early investors, I mean, any thoughts on this one, IndusInd Bank?
I think we have been keeping on discussing IndusInd Bank as a stock, and my personal view is that I've been tracking this bank for a very, very, very long time. I think when the stock was in the double digit. But having said that, the fact is, when I saw the last quarter results, Prashant, allow me to state that the problems with the bank had faced or had endured for the last 4 years because of some big accounts which had gone bad. I think certainly that problem seems to be behind the bank now. If you look at the pre-quarter update, which you all brought out very well last week, I think the loan growth of 18% year on year, 5% quarter on quarter, the uptick in retail loan growth is suddenly suggesting of improving margins for the bank. The fall in credit cost also is a big positive. So deposits also grew by 15% year on year, including the retail deposits, CASA deposits, whatever. So I would say that I have been positive as far as this bank stock goes. I have been stating it I was quite vocal on it for the last many months. I think, but we also need to understand and appreciate, Prashant, that an 800 became a 1250 in a hurry. Now, somewhere, I think, I don't know, follow much of technicals, but ask any technical analyst of your choice and he will say technically the stock has become heavy. Now, the correction which we are seeing, maybe because of this deal also, could be possibly an additional reason for that. I think I would possibly wait for maybe another 50 to 100 rupees fall at least, because I've seen a 1250, I've seen an 800. I will not be in a hurry to buy more at this present level, but certainly I will put IndusInd Bank to where it belonged maybe 4-5 years ago, in the top 5 or 6 banks, private sector banks in the country. I think last 4 years everything had become bad for it. People were talking it like just any other entity. I think all the problems are behind them. The stock has done well. The results are brilliant. I personally believe the September quarter results also will be good, looking at the pre-quarter update. But adding now after the sharp run-up, I would possibly wait for the stock to shed a little bit of weight before adding personally to the holding as far as what I am holding in IndusInd Bank goes.
Very large block deal. 1.2 crore shares changed hands. That was 1.6% equity, totally valued at 1,440 crore in IndusInd Bank. By the way, you're seeing some big moves in the cement bag. So while India Cements is struggling, that's down close to about 9% as we speak. On the flip side, look at Heidelberg Cement. That's shot up 5.5%. It's picked up on the volume charts as well. So Heidelberg Cement will come up for you on your screen. Star Cement is another one where you are seeing a gain of nearly 4.5%. So let's talk about the cement space. And the news that came out earlier, India Cements is, has announced that it will be selling its Springway Mining for 477 crore to JSW Cement. Nigel is standing by to get us more details on this. Nigel?
Well, JSW Cement has gone ahead and bought India Cement's subsidiary, that's Springway Mining Private Limited. The key asset in this particular subsidiary is a limestone mine that they have in Madhya Pradesh. The total quantum that they mentioned is around 477 crore rupees. Motilal Oswal in their note, they mentioned that they've had a conversation with the management and they expect another 127 crore rupees, which effectively was the money that was given by India Cements to this particular subsidiary, including interest. So the total deal value, they say, is around 604 crore rupees. The impact of this is they could effectively reduce that by close to 20% because the last reported debt number was around 3,100 crores. The promoter intent as well will be read possibly. And what the street will wait for is any kind of clarity whether or not they want to sell any of their other assets. Maybe the Rajasthan asset that they have, which is around 1.5 million tons. Well, it's a step in the right direction, but brokerages, they're not very enthused. Motilal says they reiterate their sell rating, though they've increased the target price to around 180 rupees. Valuations is one factor that they cite. It's trading at close to around 15 times EV upon EBITDA and also $82 on an EV per ton basis. They're saying there's no big capacity addition that they're talking about on the net debt to EBITDA basis as well. Things look elevated. Moving to Novoma, they say the move is certainly welcome, but more needs to be done on the deleveraging front. And if there are higher sales of non-core assets, then they'll be impressed. They maintain reduced with the target price at around 112 rupees from around 103 rupees earlier.
Okay, well, the stock should come up for you. There's a big knock that you're seeing in India Cements right now. In fact, Mehraboon, I wanted to pose this question to you. The entire cement pack, right, not just India Cements because of this news flow, entire cement pack has been under pressure. Demand has not picked up in a great way. Pricing has been under pressure as well. And then you have this behemoth player coming on board as well. What do you do here? Do you stay away from this space entirely or do you look for opportunities?
I personally believe there is going to be a lot of consolidation in the cement space. And let's be honest about it, that a year ago, I think not many were speaking about cement, but now a lot of people are speaking about cement. And so quite a few of the cement stocks also have gone up, especially after the deal which Adani Group announced as far as Ambuja and ACC goes. Now, coming to India Cement, if you ask me specifically, I have always believed it's a very expensive stock in terms of valuation. In the past, they had major corporate governance issues also. Let's not discuss it right now. But selling the entire holding in Springway Mining to JSW for 479 crores is certainly much below what the market could have put a number to, maybe 600, 650 crores. Like what I heard Nigel rightly mentioning it. Now, does it help the company to deleverage? Answer is yes. Is that enough? Answer is no. But we also need to understand that India Cement is working at a capacity utilization of just around 56-57%. So even if you assume that this capacity utilization will pick up and go to 72, 73, 74, 75% over the next 2 years due to the intrinsic cement demand, which is expected to pick up over the next 2 years, it will definitely aid cash flow. It will definitely aid in deleveraging the balance sheet further, and that is a distinct positive. But the valuation, if we look at in the India Cement, despite the knock with the stock has taken today, it's still trading around 18 times EV to EBITDA. Now on FY 23-24 earnings, not comfortable, certainly not comfortable. And if you put a number to it, maybe 12, 13, 14 times, the stock could possibly shed even another 20-25% from it, distinctly possible. So why should I be in a hurry to buy India Cement? The other name which you mentioned was Heidelberg, which went up today. I think 2, 3, 4 weeks ago when the deal of Ambuja ACC happened, I think I had mentioned very categorically that if Adanis are going to make any further acquisition to increase the combined cement capacity to 100 million tons, which they have been mentioning it, I think they are going to target something in central India. That's what my personal belief is. And Heidelberg somewhere believes somewhere closer to that. So maybe the market is putting 2 and 2 together. I really don't know, because if you look at ACC and Ambuja plants and map it somewhere, you will realize there is a big vacuum as far as central India goes for the combined entity of ACC and Ambuja as and when the merger is announced. So I would say that there could be some candidates over there which could be acquisition candidates for Adani's going ahead. And Heidelberg is one of them. Maybe yes. Will the parent Heidelberg come and sell it off? I'm not very sure. But Holcim did it. Holcim was a little passive player. Heidelberg, if they get a price, we really don't know. But I don't have any information on that. But that could be possibly one of the reasons what the market is right now preempting. That certain deals could happen. But on the entire cement space, I remain very positive. The thing is, people have started talking about it. People have virtually gone and bought into it. Somewhere it's become a slightly overowned, a little correction, and maybe. And ultimately what happens to crude. So if crude doesn't go above 100 and comes back below 90, you could have cement stocks possibly again attracting market attention.
All right, 160 lower on the Nifty, so 17,078 is where we are at. Now, Divi's Laboratories is in focus. It's on the losing side. Vivek is here to tell us more in terms of what he's picking up and what he's watching here on that one. Vivek, over to you.
Well, good afternoon. That's right. So Divi's Labs today is one of the losers. A very interesting note has come in from IIFL Institutional Equities, where the analyst has actually gone ahead and tracked the second quarter FY23 export data trends. So in this particular data, that point that he's actually pointed out, they are saying that they may see a greater than 20% sequential revenue decline as far as Divi's Lab is concerned for Q2 FY23. So what they're saying is that this basically indicates that the company may see a dip in revenue both in Molnupiravir, which was a one-time impact or a one-time boost that the company got in terms of revenues. That particular drug was used for the treatment of COVID. But more worryingly, it also indicates that there has been a dip as far as the base business, that is the core API business, is concerned, and which is why this particular stock, on the back of such a steep decline, is seeing a fall. Now, what is more interesting is that in some of the preview notes that we had a look at, most of the analysts have actually penciled in a 0 to 8%. In fact, BofA Securities is right in the middle, around 2% revenue decline is what they are looking at sequentially. So if you see a much larger than expected revenue decline, one of the reasons why Divi's Labs is falling today is this particular development.
Thank you very much for that, Vivek. Mehraboon, we'll have to leave it at that. Thank you very much for joining in. Need to get into a break. When we return, Jay Bala will join in to take stock of the market technicals. So stay with us.
Okay, welcome back. I mean, what's happened is that the market now has broken below below yesterday's low. Yesterday's low was 17,064. It was a pretty large candle yesterday from the low to the high. The low was 1764. The high was, 17,280. And today, it's a bigger bar, by the way, and it's still developing with 30 minutes to go, 35 minutes to go. We've broken below that low yesterday. 1737, 1740 on the Nifty now. It's a full 200-point cut here on the Nifty. And this has happened a bunch of times that, US markets, it could be CPI, it could be other news-related, data-related, impact which comes through. The market here immediately the day after does nothing. The day after, the real impact starts to come through. I remember, I think the last Fed meeting or maybe the one before that, we had a similar kind of reaction. Absolutely fantastic outperformance. Immediately, the day following a big crack in US. And then the next day, you get a proper sell-off. So this seems to be one of those. 17,030 is where we are at. Jay Bala of cashthechaos.com is with us, as always, Tuesday afternoons. Jay, good to have you with us here. Thank you very much. How are you? So what are your levels, and what's the near-term and medium-term picture looking like to your mind?
Yeah, thanks for having me on the show, Prashant. You see, I've been saying that this market had turned to a sell-on-rise mode, and there's no change in that. But the important implication for the market would be when it breaks 16,855. We always consider markets from a probabilitics perspective. So, although the greater probability, in my opinion, has been the markets are going down, the residual probability that market is bullish will get completely eliminated when the markets break 1685. Intraday break don't even need a close. So, so that's the important level for the bullish case to watch out for. The resistance for the market is about 17,430 and 17,700. From a medium-term perspective, this market is, I've been saying, even if the markets were to make record highs, it'll actually be counterintuitively bearish, and it'll be worse than the 14,000 that I've been projecting. So, right now, if and when 16,855 gets broken, the focus will be back to the June lows.
Okay, so it'll be worse than the 14,000 that you're projecting on the Nifty. I mean, are you expecting much more downside from here on? If yes, Jay, what are the kind of stocks that you're looking at? Because clearly, IT has been leading it from the front on the downside. Do you think banks will also start to participate now? And how do you approach it then?
Yeah, number of questions there, Sonia. See, banks are a shade weaker than the Nifty. The downtrend to me is clearer on the banking index rather than on the Nifty index. So, watch out for HDFC Bank. If that were to break 1365, it'll be very, very negative for the sector. And the supports, around 37,300, that'll get taken out on the Nifty Bank futures. So watch out for it. That's going to be pretty important for the sector. And IT, I've been painting, a medium-term bullish picture for it. But it just needs one more lower low below 26,100. If it does that and holds 24,400, that'll be bullish. But so basically, in the short term, some downsides need to be worked out. The sector that you said, that might, point to weakness is actually the auto sector. It's sitting on an important trend line. It's at 12,500 now, just 100 points away from an important trend line. Already, it's showing signals that it's turned. But if 12,400 were to go on a closing basis, the leading sector is turning down. So watch out for it. 12,400, the auto index is very important.
Any particular stocks in the auto pack which you're watching or someone can trade today listening to you?
See, Tata Motors is the relative underperformer within the sector. It didn't make a fresh high when the rest of the pack was making highs. So that's an important stock that if you want to be bearish on. And also, you have to wait a little bit. If Maruti were to break 8,500 and M&M were to break 1,200, these are the leaders. Profit booking might come in. So that might be another trading opportunity within the sector.
Jay, what are the chances? Lawrence Belanco of CLSA put out a note yesterday saying that it's possible that in the last quarter, October to December, we have a 10-15% rally in US markets. And he pointed out to a couple of divergences which happened in June as well. One of them was that the US Treasury note made a low 2 days before stock markets bottomed out in June earlier this year. He says that it's happened again. The US Treasury made a low on the 27th of September. Second, he points out the Russell has not confirmed a low with this, along with the S&P and a couple of other divergences. What are the chances to your mind?
Yeah, I would rate it very low. I think it's the other way. Yesterday we had the FANG Plus index, which I pointed out several months ago. I had pointed out, make sure that it doesn't cross 6100, it will be bearish. It actually went only up to 5800, and yesterday it actually broke below the 2022 low. And once again, the Russell 2000 that's the only index that's not made a new 2022 low. But in fact, the cycle for the Russell is quite different from the cycle for the rest of the stocks. The Dow Transport, Dow Industrials, Nasdaq, they are all making new lows, and the S&P is just marginally just away from the 2022 low. I would put it the other way. If there's a template of the 2008 and the 2022, the markets, tracing out a very similar path. If it follows that, continues to follow that path, we might have a washout low coming in around October 25th. So markets don't behave, in such a fashion, but watch out for it. That might be a capitulation, pretty similar to what happened in 2008. But, this is a probabilistic scenario.
Okay.
But, if 3571 on Nifty, S&P futures were to break, I think there is an acceleration very much possible there.
Okay, I mean, actually, a point taken. You're saying you're rating the chances of a meaningful bounce pullback in U.S. equities is very, very low, and you're looking at this the other way. By the way, this 2008 Lawrence in his note does say that the only risk to this is if there is a liquidity event of some sort. Then you're looking at what happened in 2008, because 2008 was precipitated by Lehman, right? That's not, of course, that was not the base case back then, but now presumably things are better, or maybe they're not. But again, no one is really expecting that. But he does put in that. That's the risk. That's the outlier. Then, of course, all bets are off. Go on. Finish that point, Jay, briefly.
Yeah, see, again, if you look at the treasuries, they're treasuries or the dollar index, the momentum is very strongly with them. And the momentum is pointing to higher yields and higher dollar index. I'm working with 117 for the dollar index, with or without a print of 109.29 on the dollar index spot. So, so the short term and the medium term and the long term for the treasuries and the dollar index is pointing upwards. So, that's a very, very significant change from 2008. And it's the recent market correlation with the 10-year treasury yields and the dollar index has been pretty important for the markets, at least in the short term. So now I'm expecting both to travel higher. In the near term, I'm working with about 430 for the US 10-year yields and about 117 for the dollar index spot.
Okay, well, you know what? The market is getting spooked by what you're saying. The Nifty is now just about at kissing distance of that, slipping below that 17,000 mark. It's a 235-point slide that we're looking at. So it's turning out to be a very ugly day of trade. We still have half an hour left for the day to end, and the sensex is down 800 points. Just look at the advanced decline ratio. It's not looking good at all. Over 2,100 stocks on the declining side. Jay, I wanted your thoughts on some of these key names that have been holding the market higher, right? So ITC, for example, has been the biggest gainer this year. Something like an M&M, Eicher Motors, the domestic consumption stocks have done well. Do you think in the next leg of this fall, do you start to see some of the outperformers give way as well?
It may not happen immediately, Sonia. I think ITC still has a little more higher highs to complete. I don't know if it will pull back sharp and then do it, but I think one more higher high is at least pending. Probably push somewhere close to its all-time highs and then probably turn down. Probably, move into, this might be a move into, buy into the defensive. M&M, as I said before, that's definitely the leader. But if 1,200 were given, I think that profit booking will set in there too.
Okay, Jay, thank you very much for that. One of the big events tomorrow is going to be numbers coming out of Wipro as well as HCL Tech. So let's quickly tell our viewers what we're penciling in from Wipro this time. Numbers do come out post-market as a dollar revenue growth of 2.4% on a quarter-on-quarter basis, constant currency revenue growth of 4 to 4.2%, so similar to what TCS reported. And this will be within the company's guided band. But in the case of Wipro, it will be also aided by the acquisition of Rising as well as Convergence. The organic revenue growth for Wipro will be lower at about 3.2%. Margins are likely to see a very minor uptick, just up 15 basis points. The company had told us last time that Q1 margins mark the bottom. But there will not be a substantial improvement in margins because the company's wage hike is effective 1st of September. So there will be the 1 month impact of wage hike, which will limit the margin gains this time. The key is going to be on the next quarter's guidance. And next quarter's guidance is important because you typically have furloughs which take place. Furloughs are nothing but maintenance shutdown by many companies, right? But if you are a company in Europe and because of, say, the gas price issue, etc., and you have to do 2 production shifts instead of 3, it's going to directly impact, right, most of their clients. So what they say about the next quarter's guidance is going to be very crucial because it is a seasonally weak quarter on account of furloughs. And are they seeing any signs of weakness? The street is divided. Kotak says 0 to 2%, CLSA is saying 2 to 4%. So something in the middle of that should be the market expectations, particularly for Wipro. Keep your eye out on deal wins because they've been strong. And as I said, deal wins are usually a lead indicator. It's seen as a proxy for future growth. So that's going to be very important. The ability to improve margins, because Wipro's margins at 15% were a decadal low. In Q2, we're not going to see a substantial improvement in margins, but thereafter, can there be a significant improvement in margins? And finally, watch for Capco. Capco was an acquisition that the company did. It's focused in Europe and it's focused in consulting. And consulting is typically seen as a discretionary area of tech spending. So is that coming under pressure? So these are some of the important things to watch in the case of Wipro. Let's get into a break. On the other side, we'll tell you what to buy today that you can sell tomorrow. Calls coming in from our technical experts.
All right, we briefly went close to that 200-day moving average. So 16,980 is the 200 DMA. And the low that we hit today was 16,990. It's perhaps just a matter of time before we get to that level. Not look good for the market. Now back above that 17,000 mark. But Mitesh Thakkar is with us to tell us how to approach the last 10-15 minutes of trade. Mitesh, what would the buy today, sell tomorrow calls be? And what about the index itself? Do you think the 200-day moving average can get taken out?
I think eventually it will. Now, for the time being, we have had a minor bounce back from those levels, and it's only about 20 points higher from those levels. I think eventually we will see the 200-day average break. So I think the next shorting should come in once you break the 200-day average and then take a 35-40 point kind of a stop loss, buy into put options on the index, and then take a call from there. So that's the way we'll approach the markets. On the stock side, Hind Copper is something, which has come on my radar. That's a stock which is closing with a negative bias. So I would suggest selling this one or taking a STBD kind of position. The stop loss should be just about 109.5 and the target would be in the range of about 105 thereabouts. And HUL is another one, which is a STBD with a stop at 25.70 for targets of 25.35.
Thank you very much, Mitesh, for that. Abhiram Eleswarupu, the head of India Equity at BNP Paribas India, is now with us on the show. Abhiram, afternoon, and thanks so much for joining in. What's the call on the markets, right now? We've gone through nearly 1 year of consolidation. We've outperformed the global market, but we're finding it difficult to break out, but we're also not collapsing. How would you view the next 6 months now for the Indian markets?
Hi, Rima. Thank you for having me on the show. I think there are two major points that investors are looking at today. One is, of course, what you just mentioned, that India has significantly outperformed year to date. I mean, take a look. The market's probably flat year to date. Most global markets are down 20 to 30%. So the bar for further outperformance has just gone higher. And investors are now questioning whether there's more outperformance. The second element to watch out is that there is some evidence that quite a bit of the outflow seen in North Asian markets such as China found their way to India as investors looked at higher earnings growth and so on. And this week and the week after that, there's some important events happening in China, including the Chinese Party Congress. And usually that event is followed by some announcements of laying out a growth path for the long term, and also some potentially relaxation of COVID protocols and things like that. And we think that China could therefore open up a little bit faster than investors think. And my sense is that some of the outperformance that India has had over regional peers may actually start to go away in the next few months. So I think a critical event next week is the Chinese Party Congress.
Although, yeah, I mean, the big one is whether they will abandon their zero COVID policy or at least indicate a shift to it. One does not know. That's on Sunday. 254 down, by the way, and things are still remain down and out. So interesting markets. And of course, looking quite poor overall. Mazgaon Dock, which has had a one-way move, is seeing a large cut today, backed on the back of some very large volumes. It's down 7.5%. I think even after, okay, yeah, it's up 18% after today's cut, just in October. Ambuja Cement is down 4%. India Cement, we highlighted some 11.5% cut. There's United Spirits, which is down 4.5%. Havells is down 5%. And so on and so forth. It's a big volume-led day on the downside, which we've not usually seen. Usually, you know, even on down days, there is not too much momentum on stocks which sell off. But today is slightly more different with volumes backing this move. Abhiram, so what should the overall portfolio strategy really be? You know, where should one kind of concentrate one's money in? What should one get out or get in? What's your advice?
Yeah. So Prashant, of course, I mean, going by what I just said, I'd obviously be quite defensively positioned. But just before getting into sectors, I think one of the critical things that investors need to watch out for, and something that we've been saying quite a bit, is the earnings yield gap that we have in India today. It's below -2%. I mean, such a scenario has only been seen a handful of times over the past, let's say, 15 years or so. And almost each time has been followed by a significant correction. So that's a very critical element to watch out for, in my opinion. On the other side, if you want to take a converse kind of positive view on the market, then maybe you could take the call that yields have topped out in the US or other places, and therefore you could have some sort of a rally in 4Q. But I think even in that sort of a rally, India may actually underperform, just given what it has done year to date. So in terms of sector positioning, I think obviously we need to go defensive and probably avoid sectors where there is a lot of debt, for example. The spaces that we like, first we continue to like financials, of course, selectively. Some of the large high CASA banks, I think, are still looking okay. Then insurance is quite good. I actually like IT and healthcare. It's slightly contrarian call there. But the view here is that those sectors have underperformed. They're not only classic defensives, but also fundamentally speaking, I mean, based on the results that we've seen so far, even from global peers, it suggests that IT demand is not really that bad, actually. So it's a space worth looking at, along with healthcare. And as I mentioned, just look at stocks that offer good dividend yield to top that all off.
Okay, I do want to take that point forward. You liking IT stocks, but just before that, the Nifty has now given up on the 200-day moving average quite effortlessly. It's now 16,976, so it's a slide of 1.5%, and it's getting worse by the minute. So not a good day at all for the bulls. But Abhiram, on IT itself, since you're keeping the faith here, and to be fair, companies like TCS have said that demand is, they don't have visibility, but for now they don't expect any client cancellations, at least for the next 2 quarters. What do you do here? Do you stick with the large caps? Do you look outside the index? Because there are some auto-related IT plays that have done quite well and have held fort despite the challenges. Where would your preferences lie?
I look at the playbook of previous slowdowns or recessions. Typically, what we've had in IT is that you tend to have a couple of quarters where there's not a whole lot of growth or maybe no growth. If you're in a recessionary kind of environment, once you factor that in, then you'll probably see that the risk to maybe revenue growth estimates are probably around 2, 3, 4% maybe. But what tends to happen in such a scenario is that the large cap companies are able to offset that with better control over their costs and maybe their attrition. And the earnings cut also tend to be proportionate and much lower than what you tend to see with mid and small cap companies. And usually we've also seen during downturns that larger companies tend to hold up their order books a lot better than the smaller ones. I'm not sure if there could be a change this time. There's a structural change, maybe with mid-cap companies trying to do better. But the playbook of the last several slowdowns is that large-cap companies have come out better during a recessionary environment.
Okay, talking about IT, tomorrow HCL Tech 2 will be reporting numbers, and here the key is going to be, does the company hold on to its this year's margin guidance? The margin guidance for HCL Tech for FY23 is 18 to 20%. In Q1, when margins came in at a decade low, HCL Tech already moderated the margin guidance, and they said margins will be at the lower end. But even there, the street is not convinced the company will be able to meet this margin guidance, right? Kotak is, I think, anticipating 17.8% margins for this year. Even Ambit is anticipating lower margins for this year. The fact that the company will not be able to meet its margin guidance. So the key this time is going to be, does the company reiterate, hold on to its margin guidance? The numbers are up for you on your screen. There will be a revenue growth that we are anticipating. Margins, according to the CNBC-TV18 poll, will be up 40 basis points, impacted by a full quarter impact of the wage hikes. And again, other things like, commentary on deal wins. Does the deal win momentum continue, hiring, etc.? All the soft issues will also be fairly critical. Abhiram, we've spoken a lot about IT. Wanted to get your thoughts in on banks. Now, in the banking space, in the insurance space, you like stocks which are under-owned and are less expensive. Could you give us a hint? Where is this? Because, the consensus view appears to be overly optimistic across the financial space.
Yeah, now, like I mentioned to you earlier, Rima, in the within the banking space, actually there is a case for just the top 3 or 4 high CASA banks, and I can't get any more specific than that, but those banks gaining market share in such an environment. You see, when you have a slowdown or when rates are going up and credit growth starts to slow, then the market share tends to get, again, disproportionately move towards the larger high CASA banks. And I think that is the area we'd like to focus on. On insurance, the numbers have been okay-ish so far, not the most spectacular numbers, at least over the last 1 year or so, but I do see that as a structural 5 to 10 year theme. Basic point here is that Indians are underinsured. As a country, we are underinsured. And that theme will go on for a considerable period of time. Even within the top 3 or 4 companies within the insurance space, we see a 15 to 20% kind of a growth CAGR and therefore a compounding effect. So that's a space that we continue to like.
All right, Abhiram, we'll leave it there. Thank you very much for your time. Great speaking with you. Appreciate you joining in with some of that perspective. Well, the market is down and out, and with 9 minutes to close, there is very little which I'm assuming will happen now with something dramatically different. Unlikely. Under 17,000, just like that. And it's a big candle on the bar, the intraday bar, 16,965. We'll take that quick commercial break. There's more coming up on the other side. Stay with us.
Okay, we are counting down to what has been quite a disappointing day for the bulls. The Nifty will go home at the lowest point of trade, down about 270 points right now, 285 and counting actually. The sensex, surprise, surprise. I don't think anyone expected this at the start of trade, such a steep fall in excess of 900 points. And now the Nifty below the 200-day moving average of 16,980. It's, of course, global concerns that are center stage, and the Dow futures as well, indicating a start will be in the red. We had a chance to speak with Vineet Samre, who was our market master of the day. He was quite cautious on the market as well. Take a listen to what he had to say earlier on.
This type of market, which is not a raging one-sided market, is a good market for the long-term investors. You need some consolidation. We've risen for the last 1.5 years, and since the pandemic, and the last 1 year we've been consolidating. So I think that's a good phase. I would say some bit of consolidation weakness because of the global macros allows the long-term investors to work with a more patience, look at good businesses, good companies, and invest with a long-term horizon. So I would say some bit of more consolidation, stroke weakness likely in the Indian markets given the global context, but the long-term view remains intact as far as India is concerned. We've seen good correction as far as the IT sector is concerned, and this is actually getting linked to the global technology correction as well. There is a lot of talks about recession and the impact of that. I think what is known today is that surely the global economies are going to slow, but what is sort of unknown is that what beyond that. I would imagine that technology spends are likely to continue. Maybe there could be slower growth, but the growth itself will remain. Good part is that because of this correction, the valuations have become more palatable, is what I would say. The next 6 months, when the noise around the recession slowdown is high, and let's say the stocks tend to consolidate or weaken more, I think that probably should be a good opportunity to keep accumulating.
All right. I mean, yeah, that's absolutely true. You get to buy, but things are cheaper when the markets are down, but you got to act as well. But for now, I mean, there is a big cut today. 284 lower is how we're going to end, below the 200-day moving average. And I think, the low on the 30th of September, I guess, comes back into play from where the market had bounced nicely. The low was 16,747, from where we saw a nice move all the way to about 17,420 or so. So 16,747 back in play, not very far, 200 points away. I think that's what one will watch. Mitesh, anything else you'd want to recommend as we wrap down?
No, I think the only issue, Prashant, which I would want to highlight is that the closing could be below the 200-day average, and the intraday, the hourly and the 2-hourly charts have clearly gone negative. So I think it might not be a bad idea to, look into doing some bearish spreads on the Nifty, buy a 17,000 put and sell a 16,600 put in about 1.25, 1.4 times ratio. I think that kind of a spread could still work out very well.
All right. Mitesh, thank you very much. Appreciate you joining in and running us through what you would want viewers to do. All right, let's just quickly start wrapping up things in terms of what the day looked like. Very different as compared to what we had early on in the morning. And actually, we started in the green. I mean, 15 points, 20 points, but there was immediate selling after that. But it only picked up in the last 2 hours of trade. So that's the Nifty 50. Mid caps and small caps came under pressure. And broadly, I mean, in the broader market, it was a very heavy volume-led day on the downside. Real estate and metals were the big losers. The IT also, I mean, Fines mentioned there, with not quite a 2% cut, but close to that. Divi's Laboratories, IndusInd Bank, Nestle, JSW Steel, iShares and UPL are some of the top Nifty losers that we had today. Market breadth, needless to say, deep in the negative. Rima.
Well, the mid-caps underperformed for the second day in a row. The mid-cap index goes home with a cut of nearly 2%. The advanced decline ratio worsening significantly by the end of trade, 2 in the green for nearly 7 in the red. India Cements was the big loser, down close to about 12% Mazgaon Docks, a stock which has doubled so far this year, comes in for profit booking and steep profit booking, ending lower with a cut of close to about 8%. Weakness seen in names like Zomato, IDBI Bank. A big mover from yesterday was down close to about 4.5%. A couple of commodity names like NMDC, Vedanta, SAIL under pressure, and Kalyan Jewellers as well, which reported a pretty good business update a couple of days back, was under pressure. On the gaining side, Panacea Biotech stands out as an island of green. Investors perhaps sought safety over there after it won that large $130 million deal. So still ending with cuts of close to about 18.5. So unscathed by the market turmoil, Panacea Bio, Sonia.
Oh, absolutely. Panacea Biotech was really the stock that stood out, right? But for the markets overall, as you folks pointed out, I mean, very disappointing day and largely secular on the downside, right? So whether it was Divi's Labs, JSW Steel, IndusInd Bank, Eicher Motors, across the board, you slice any pocket and there was pressure. So it just goes to show that the profit taking was the name of the game today. And even the bank Nifty was, ended with cuts, very deep cuts of 440 points. I don't think anyone saw this coming. The only outliers today were Axis Bank, Adani Enterprises and Asian Paints. Only 3 stocks ended in the green. Apart from which, all of the Nifty constituents ended well in the red. Even the cash market volumes were quite high on the downside. So we ended with almost 55,000 crores of cash market volumes and huge F&O volumes as well. Not a good sign when the market is falling on large volumes, an indication that perhaps there is more to go on the downside. As Mitesh Thakkar was telling us before he left, the 200-day moving average, just a matter of time that it would have been given up. And now that that psychological level has been breached, perhaps there are lower levels to come. But let's thank all our guests for joining us on Closing Bell. You folks have a great evening. Thanks for watching. When we come back, we'll shift gears away from equities into commodities. Our show Commodity Champions will be with us in just a bit. Stay tuned.